And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is a very special guest, Brian Adams, who's the president and founder of Excelsior Capital with approximately 475 million in assets under management. Brian, welcome to the show.
Hey, thanks for having me, Adam.
So Brian, I always like to begin. Can you tell us a little how you got started, your story, and how you got involved in the business?
Yeah, happy to. I'm a New Yorker who married a Nashville girl. So my wife and I met up in college in Connecticut. We lived in the Northeast for a bit. We both went to grad school up in Boston. I went to law school up there and she got her master's in education. Like most Nashville girls, she wanted to move back home. And so 15 years ago, we relocated to Middle Tennessee. My wife's family has a single family office based here in Nashville. And my father-in-law and our CIO have invested in private equity, both commercial real estate and healthcare for the last 25 or 30 years. So when I moved to Nashville, I practiced law for a number of years. I then connected with another New York guy who married a Nashville girl. And given the experience that I had being an investor with the family as an ex officio board member, I started the business 10 years ago. And over that time, we've done a lot of different things. I'm sure we'll get into it, but that's kind of how I fell into the commercial real estate business.
What kind of law did you practice?
I was actually a prosecutor. So I worked in the district attorney's office for Nashville, Davidson County, and I was on the vehicular trial team. So trying anything from an open container, which is a C misdemeanor, to a vehicular manslaughter, kind of A felonies, et cetera. So great job. I love trying cases. And it was a really cool way to get to know Nashville outside of kind of obviously my social circle involved with my wife. But it's the kind of thing that you do for 5 years or 50 years. And I just was not a lifer. But being on your feet and pitching 12 strangers your version of the events is a pretty good skill set to have when you're young. So
right. No, that's fantastic. I was on the law trajectory as well, ended up in finance, hence the question.
Yeah.
So next question for you, Brian. Can you tell us a little about your investment strategy?
Sure. So when I started the business, I think like a lot of entrepreneurs and sponsors, especially in my real estate world, I came out of the box with an idea that I thought was cool and interesting, and it would be great fit for everyone I knew. And so I had a concept of doing urban infill development for the most part in Nashville, and it was fine. And we did some good deals, but raising capital was a challenge. And what I discovered was I was going the wrong way about it. So instead of going to my logical investor base and understanding their pain points, I was trying to jam a product down their throats they really didn't want. And so 3 years or so into the business, I started actually listening to my investors and my prospective investors and understanding what they wanted. And I pivoted towards providing them a solution to their pain points. And those are really three things that we do. One, a place to put capital that is uncorrelated to the overall markets. Second is a way to garner some kind of passive income yield on a monthly or quarterly basis, depending on the opportunity. And the third is to really take full advantage of all the tax benefits that come from direct real estate ownership. And so once we started doing that on a deal by deal syndicated basis, the company grew very dramatically. And so our product offerings will change depending on the market or the opportunity set. But those are the three things that we focus on. Those are the problems that we solve for our investor base.
Just in case if anybody's not familiar with the strategy, urban infill, can you explain that a little bit?
Yeah, so it's essentially going to what would be gentrifying neighborhoods or burgeoning neighborhoods within a larger metro area, taking down old, antiquated buildings and repurposing them or developing new products that are more oriented towards what that new population would want. So think about taking a small multifamily property, an old apartment building, like a quadplex built in the 60s or the 70s that no longer really fits within that neighborhood. And you build retail on the bottom and then residential on top, for instance, a 2 or 3 story building. So much more development oriented, opportunistic returns, but a whole host of other risk factors involved. But that's how I kind of started the business, how I cut my teeth.
I like it. And then you said you were able to, instead of jamming down your strategy, you listen and reflect on the pain points. What are some of those pain points that you've come to learn?
Yeah.
Like to learn earlier on?
Yeah. So even ultra high net worth individuals or very affluent family offices, and I think this is still the case today, frankly, they may have a lot of AUM and they may have exposure to a lot of different opportunities, but within private equity real estate, oftentimes the only deal flow or access to opportunities that they have is either through a REIT structure, which is really suboptimal and a poor proxy for direct investment, or a fund of funds vehicle that a financial advisor will bring to them. So a Blackstone or a KKR or a Carlyle, where the fees are pretty steep. It's a very opaque structure, and there's no real relationship with the GP. And frankly, that GP, the general partner, the person who's running that fund, is much more oriented towards catering towards the larger investors, which are usually non-taxable institutions like a pension plan or endowment, et cetera. So for the most part, the pain point that I saw within my investor base or prospective investor base peer group was that they were looking for some way to generate income because yield has been impossible to find quality yield over the last 10 years. And they really wanted access to direct co-investment opportunities and not have to commit to a blind pool commingled fund or to go through a friend of a friend that they didn't really know. So try to bring that institutional quality opportunity set to the upper middle market of individuals and families.
Right. So if I hear you properly, they wanted transparency and income. Is that correct?
Correct. Yeah.
I love it. So I guess, Brian, how do you handle risk? I know you're in real estate, so it's not like you're trading stocks or anything along those lines. But how do you handle risk? And then what mistakes do you see people make with respect to risk management in both sides of your business, from the private equity side and also the real estate side?
Yeah, this is a great question. So I'm going to talk about it from a high level in my business, and then we'll talk about the actual real estate itself. I think one of the biggest issues that, and I'll say sponsors because that's what I am. A sponsor is somebody who finds an opportunity, sources a deal, runs the deal, manages the deal, and is an operator of that asset. So as a sponsor, I think oftentimes new ones are very focused on just making sure the deals work, right? I'm going to find the best deals. I'm going to get the best IRR, which is great. And you should do that, right? But there's a whole other aspect to being a sponsor and being in the real estate business that requires the infrastructure of running a small business that has nothing necessarily directly to do with the real estate investments themselves. I'm talking about tax, audit, marketing, reporting, HR, all of these things that any small business would need that obviously are impacted by the real estate investments you're making, but they're not directly associated. So as an investor, you're taking two risks when you invest with a sponsor. One, they know what they're doing on the real estate side. Two, they know how to run a small business. Right. And I think it's a really underappreciated risk. And it takes a lot of time and money and energy to build that infrastructure, to have that small business in place. But it really does make a huge difference on how the experience is and what the journey is like for an investor. So that's kind of one of the risks that I see, that I think investors need to ask more questions about. Once they diligence the deal, that's fine, but they should ask these whole other host of questions about whether or not this person can actually run a small business, because if that business blows up, your real estate investments are going to go sideways too.
Yeah, game over. Yeah, the key man clause, all that kind of fun stuff. And yeah, I understand. Running the actual business of managing money is a risk in of itself that most people don't even talk about. They just assume as long as the investments work, the business side of it work, but not always.
I mean, when you look at the numbers, small businesses in America fail a lot, right? And when you look at, in your space, if in the hedge fund world, for instance, it's typically not the investments that go sideways that make hedge funds blow up. It's the personalities internally, lack of oversight, lack of governance, et cetera. So those are really the issues that I think are almost more important than the deals themselves, because you've got to assume that these people are smart, motivated, and that the incentives are aligned well enough that they're going to try really hard to make money. It's these other issues that usually get in the way. And family offices are the same, frankly. It's typically not the investments. It's the qualitative, emotional drama internally that can really put you on the rocks.
So. Yeah, people love drama is what I say. And people are people no matter where you are or what you're doing. So if you can remove that from the equation, you're way ahead of the game. Okay, that's great. And then how do you handle risk from the investment standpoint?
Yeah, so this is a really good question. And the way I think about it is individuals and families and independent RIAs or boutique wealth management firms, which is who we work with, I think they really need to take a step back and think about their returns on a net of fees after tax basis and on a risk adjusted basis. So when I get the question of, well, where should I invest in commercial real estate today? It's a spectrum of opportunity, right? So if you're really risk on and you want to make some real money, yeah, you can go and buy up a bunch of hotels, but you probably need 2 years of carrying costs, and you probably need to buy cash. And there's a lot of risk associated there, but you can make a lot of money. On the other side, if you want no risk and you want to invest in commercial real estate, you could participate in an Amazon industrial distribution warehouse, but the yields are probably going to be 2%,
right?
Maybe. And that's probably levered, maybe 2 or 3%. So I personally think if you're an investor, an individual and family, a taxable investor, to make up for the illiquidity and the risk premium associated with doing something with a sponsor like myself, in today's market, I think you need to be 6 to 7 to 8% cash on cash yield day one to justify all that risk, plus some upside.
Right.
And when you look at the spectrum of commercial real estate, in order to get that today, you're probably looking at office, flex, industrial, maybe some multifamily, maybe some single family. And so I think those are the food groups or the asset classes that make the most sense on a risk adjusted basis. But that's how I kind of think about the risk spectrum of commercial real estate. We can talk about our underwriting on the deals itself, but that's on a high level, I think, how people should be thinking through it.
Almost like diversifying it, if you will.
Right.
Into different buckets. I got that. So now with COVID, obviously that's completely changed the game for for real estate in general, commercial and residential. We've seen a big boom in residential real estate prices due to the Fed keeping rates artificially low and, all that fun stuff, pumping 120 billion, I think it is, every month into the economy, so on and so forth. How has that impacted commercial real estate? What are your thoughts there with respect to a timeline of when we get out of here, where are we now, where we're going, all that kind of fun stuff? If you can speak to that, I'd appreciate it.
So I'm for the most part, we focus on office and industrial and flex, which is a term that means that it's a hybrid between office and industrial. So think about office in the front, distribution warehouse in the back kind of product. The single story, second story product that you see outside of an airport, for instance.
Understood.
That's typically where we invest. So I can comment on that. I could make up a bunch of stuff on other asset classes.
No, stay in your lane. By all means, please stay in your lane. Yeah.
Yeah. So, we all suffer from recency bias, and this narrative that nobody is going to work in the office any longer, I think, is a real product of that recency bias. Now, pre-COVID, 4% of the workforce worked remotely, which I think is important to draw a distinction between remote work and work from home, because they are two different things. Mm-hmm. Clearly, in a post-COVID world, more people are going to be working remotely and from home more often than they were before. Mm-hmm. That being said, this trend that we saw over the last 10 years of what we call the WeWork effect, really, really dense spaces, hoteling, hot desking, trying to cram in as many people as you possibly can, resulted in a per square foot usage of almost 75 square feet per user.
Oh, was it rich?
Wow. Well, in some of the WeWork locations, like in Midtown or San Francisco, are very expensive markets. Right. It was down to 75 square foot per user, per employee.
Understood. Yeah.
Traditional offices are around 350 square foot per employee. So I think you'll see the pendulum swing the other way, where we'll get away from density. People are going to want more traditional office layouts. They're going to want a place where they can be quiet and think, away from the house or away from wherever they're working remotely. Mm-hmm. And you're also going to need more collaborative conference room space. I mean, clearly there's been a lack of innovation, a lack of productivity, and that novelty of working from home is really worn off. And so to engage in that corporate culture building, you're going to need more shared space. So all that being said, I think it'll end up being kind of a wash for commercial real estate and for office. Now, I do think there'll be some real pain to be had in New York and San Francisco and some of these other large coastal markets that are democratically, politically held. I think it's going to be a very challenging 3 to 5 years there. But for secondary markets and suburban office product, I can tell you today that cap rates, which is kind of a function of how much you pay for a building based on how much income it produces, which is a way to compare apples to apples, cap rates have gone down since COVID.
Wow.
So if it's a well-located property with good credit tenants and it's a suburban office, it's going to be more expensive to buy it today than it was before COVID occurred. So quality, distributions and quality yield, people are paying a premium for it. And I don't think that will change anytime soon. And you continue to see the headlines. Larry Ellison of Oracle today,
Texas.
yeah, he's moving to Texas, and he
Yeah.
personally is moving to Hawaii to get out of California. Elon Musk. I mean, these headlines are going to keep coming because the problem is some of these major coastal metros, the only option they have to take care of their budget shortfalls is to increase taxes on wealthy people and decrease services.
Yeah.
And so you're getting into a death spiral where, affluent people are going to leave. They're going to take their businesses with them. That means those cities are going to have to increase taxes even more and cut more services. It's going to be a long 3 to 5 year cycle for them to get out of that.
Understood. Now, I like what you said about the density, the vertical density of being in buildings and packing people in there. So you're saying, well, I want to ask you a question about valuations. What are your thoughts on valuations from your world, commercial and industrial real estate?
Yeah.
Are they undervalued, appropriately valued, overvalued? If you can speak to that a little bit, we'd appreciate it.
Yeah, I mean, the values are what they are, right? I'm not the one to adjudicate whether or not they make sense, but it just is what it is. And I think when you take a step back and look, okay, stock market is ripping, IPOs are going parabolic, seemingly disconnected with the real economy. Fixed income is atrocious. Bonds are giving you nothing. Corporate debt is way out on the risk spectrum and also giving you nothing.
Yeah.
So if you're looking for some kind of yield, a safe place to park capital and participate in some upside, commercial real estate in the US is probably the best bad place to be right now. And you're going to continue to see international money come in and cause cap rate compression, frankly. I don't think that's going to change. So for my business, cap rates in the 7 to 8% range is probably realistic. But I've been telling my investor base for the last 5 years, listen, we need to rethink what our yield premiums are and what our yield thresholds are, because yields are going down across the board.
Yeah.
What was 8% 2 years ago is now 6%.
Right.
It's just the nature of things. To your point earlier, the Fed keeps flooding the market with free money, keeping interest rates artificially low. People are looking for a delta between what the 10-year is going to give them and what some other fixed income asset's going to give them.
Right.
And that spread keeps getting, shorter and shorter.
Yep. So I guess a few thoughts here. From a investment standpoint, if somebody wants to get into commercial real estate, are you seeing a high number of defaults right now? Or how do you handle defaults with the last 6 to 12 months or so? And where are they? Is it an issue going forward?
Yeah.
So space.
Yeah, the CMBS numbers from Kroll, they came out, the November ones came out, I think a week or two ago. And CMBS is a debt instrument that a lot of commercial real estate owners use. And it's a good proxy for where the market is.
Yep.
It's a huge industry, obviously. Office, I think, was right around 3% default rate. And hotels was 25%.
Okay.
So I think it's going to get worse before it gets better. But when you compare what it was like in 2008, 2009, it's not anywhere close.
Yeah, I was going to ask historically, how does that rank?
Yeah, so it's still, lenders have been very accommodative. And frankly, for commercial real estate, it's very difficult in my business to know and to make some kind of prognostication about what's going to happen next year or in 2 years, because my average lease term is north of 5 years long.
Right.
And so as long as the business is solvent and, these are legal liabilities, right? They're guaranteed leases. So for the most part, people are still paying their rent. And so it's very hard to know what's going to happen. What you are seeing in the near term is muted new leasing activity. And obviously lease renewals are just kind of slow. And instead of doing a 5-year lease renewal, a user or a tenant might do a 2-year deal for what's called like carpet and paint. So instead of doing a 5-year renewal and having a bunch of tenant improvement dollars and like building out new offices or new infrastructure, they're just saying, hey, I'll do a 2-year deal. Give me some new carpet, some new paint, and let's see what happens here. Yeah. I think that's what you're going to see until the vaccine gets fully rolled out and there's some kind of return to normalcy in Q3, Q4.
Yeah, no, that makes perfect sense. And then Brian, another question for you. So with respect to getting into the commercial and industrial real estate arena, if you will, do you recommend other people do that? Or do you not recommend them doing that, and why or why not?
As an investor?
Yeah, as an investor, yeah.
Yeah, this is a good question. And it's interesting with COVID because I personally think that the democratization of access to alternatives is going to be a big theme we see play out in the next 10, 20 years. And what's cool about what's happening now is because of LinkedIn, podcasts like yours, webinars, ebooks, there's so much content out there that if you have time for very little money, you can educate yourself about almost any aspect of commercial real estate, more than you ever probably want to know. If you go to our resources tab on our website, we'll crush you with all kinds of content that, you
In a
may or
good
may
way.
not.
In a
Yeah. I
good
mean,
way,
it's just anything you want.
Yeah.
And so my recommendation would be, and you're in this business more than I am probably, but take a percentage of your liquid, net worth, whatever that percentage is going to change depending on how many zeros you have and what your risk appetite is, but take a percentage, annually chop that up into, 10 deals and start spreading it around. Don't go all in on a winner. Don't over allocate to a certain sponsor. Do some apartment deals, do a self-storage deal, do an office deal, look at some of the crowdfunding websites. When you do an investment with a sponsor, lean on them to be an educator for you, right? Like if you invest with me, make sure that you're going through my quarterly reports. Make sure you're going through the monthly financials. If you have questions, call my asset manager, understand how it's working, what's not working, what the leasing looks like, et cetera. And that way, I think after 2 or 3 years, you'll get a pretty good sense of what you like, what you don't like, what style of investing is good for you, what your return profile expectations are. That's my recommendation, would be to kind of spread it around a little bit. Part of this process is unfortunately, it's difficult to find sponsors like me, even though I'm everywhere seemingly with LinkedIn and all these other things. There's 12.4 million accredited investor households in America. And, I've got 500 investors. So it's still a challenge for us to meet each other in the marketplace and understand what, how that works. But I would definitely encourage you to, think, if you're new to investing in commercial real estate, invest in what you know, right? I mean, if you live in an apartment building, look at apartment deals. If you work in an office, look at some office deals. If you own or rent a self-storage facility, look at some self-storage. I mean, these are things that are tangible, that you have maybe some experience with. That's where I would start the conversation.
No, that makes perfect sense. So, Brian, what are some timeless lessons you've learned along the way that you'd like to share with the audience?
God, I've made a lot of mistakes.
That's the next one too, by the way. If you want to throw that one in there too, we can go, what are some timeless mistakes you've learned and how do you avoid them?
Yeah. So I guess we'll do lessons and mistakes maybe together, but if you were thinking about starting one of these businesses, or you're an entrepreneur and you're going in with a partner, if you're not mature enough to have the conversation about how you're going to structure the operating agreement and what will happen given a scenario of death, divorce, or disability, which are kind of the 3 biggest issues that come up. If you're not mature enough to have that conversation and to get third-party counsel to represent you in that negotiation, you're probably not mature enough to go into business with this person.
Agreed.
It's kind of like a prenuptial agreement.
Yep.
You can structure the prenup any way that you want, but if you out the gate say, no, this is ridiculous, we're not going to discuss this, it has nothing to do with our relationship, you're probably not mature enough to get married, in my mind.
Delusional. Yeah.
So, nobody looks at the operating agreement. Nobody looks at the antenuptial agreement unless something bad happens.
And that's when you have to look at it. If you don't have it in place, you're toast.
Right. So if you say, oh, these lawyers are so pessimistic, they're deal killers, blah, blah, that's their job. Nobody looks at an operating agreement when the deals are great and everyone's making money.
Right.
But look at the operating agreement when things are going sideways, things are bad, something bad happens.
Right.
The deal is losing money. And so that's a big lesson, is just because they're your friends doesn't mean that it doesn't need to be papered correctly. And that goes for that applies to a lot of spectrums of your life, I think, in my opinion. That's definitely a lesson learned. And then I think underappreciating the risk associated with some of these investments. I don't think some investors understand what risk actually means. And if you're going to look at a development deal, for instance, or something with a big IRR, a big multiple associated with it, in order to get those type of returns, you need to take outside risk as well.
Right.
And that risk is not that you're not going to achieve those returns. That risk is a permanent loss of capital.
Right.
So, which is a huge difference, and it's a pernicious effect, because not only have you lost that capital permanently, you've lost the opportunity set of putting that money to work in something else that could be generating you returns.
Yeah.
And so it's a very challenging concept for some people to understand who are new to private equity investing.
Yeah.
And then the other risk would be the one that I talked about, small business versus the real estate side. I mean, that was a big lesson learned for me. I did not, when I started the company, put the adequate resources to work in that area. And I got my teeth kicked in really badly. Even though the deals were doing well, reporting was atrocious and the investor relations was poor, just not up to snuff.
Understood.
And that was a big mistake I made. And I think has ultimately made me a better manager, but was certainly a painful experience to go through while I was kind of rejiggering that entire process. Took me probably 2 years, frankly. So
Yeah, no, that's some really, really good timeless advice and some mistakes to avoid because most people don't even think about it. That's really good. So what advice would you give your younger self, maybe your 20 or 30-year-old self, of what to do or what wouldn't you do or go in a different direction, things of that nature?
yeah, I would have bought more real estate in Nashville for sure. That was a mistake. Who knew that we'd become the it city? But all joking aside, I think, you know, I started the business 10 years ago now. So I was 28 and had my oldest was a year old, maybe 6 months old. And I think the advice that I would give myself at that time is to appreciate the fact that there's a reason that this process is difficult. I think oftentimes as entrepreneurs and people who want to start businesses, they look for a turnkey solution to a lot of their problems.
Mm-hmm.
And I think now, with the benefit of hindsight, I can see that there's a reason that raising capital is challenging. There's a reason that starting the business is challenging. It builds scar tissue up for you, and it makes you learn a lot of hard lessons early before you're really dealing with a lot more money, for instance, or AUM or et cetera. Just be comfortable with going on that process and have faith in the fact that things may take slower than you want, but you're learning a lot along the way, right? And I think when I meet young entrepreneurs and sponsors, they just want to say, well, I just want to hire a third party to raise all my capital. Well, you're not going to get anybody decent, and it's not going to work. You need to be the chief sales officer, and you need to go through getting all those no's, understanding your value proposition, getting that hard feedback, all of these challenging things. And I think oftentimes, entrepreneurs just want to do the deals. And they don't want to deal with everything else associated with starting the business. And I certainly was like that too. So encouraging myself to have a little bit more patience, which is still a challenge for me, I think would be a big piece of advice that I would give myself.
I love it. Yeah, going back to the young kid reference, I learn a lot from adults from studying my kids when they were young. And if you ask, use that analogy with the 1.5-year-old, 2-year-old, or even younger, when they're starting to crawl and then walk, I want to just outsource it, let someone else walk for me. You can't do it. You got to crawl, fall, get up, fall, and then eventually you can walk and then run, so on and so forth. But that was, it's so true what you just said, because most people just want the easy fix of, hey, just do it and just get it done and not have to worry about it. But you don't learn that way. And most of the time it doesn't work that way.
Yeah, that's right.
I love that. So finally, I guess, Brian, what is the best piece of advice you'd like to share with the audience? If there's anything that you haven't already mentioned, because you've shared a lot of good advice with us.
Yeah. My advice to the audience would be, if you don't have exposure to private equity or you don't have exposure to alternatives, and you think the market will give you everything you need, either fixed income or stocks, you've got to realize that if you have a 401k, if you have an IRA, and unfortunately, if you have exposure to the federal government, you're already in the private equity business. And you owe yourself a duty to at least educate yourself about what alternatives are, what they aren't, what private equity is, what it isn't. Because if you look around, if you are in an index fund or in the market, you probably have some kind of exposure to, the financial services firms like Blackstone, JP Morgan, Carlyle, Goldman. And these groups fundamentally are in the private equity business. And the market is giving them a valuation based on their ability to raise capital and to get that carried interest ultimately. So, for better or worse, this is the world that we're entering into. There's fewer and fewer publicly traded companies. IPOs seemingly are really disconnected to the underlying businesses. I mean, I think I read yesterday that something like 20 of the IPOs that went out this calendar year still aren't profitable companies. Mm-hmm. So if you think that you're risk off by getting exposure to the market, I think that's a fallacy, that you just should open your eyes and understand what other opportunities are out there, or maybe what these Wall Street kind of products actually have inside them today.
Got it. No, I love it. Well, that's really good advice. And thank you, Brian, very much. It's been an absolute delight.
Yeah. Thank you for having me, Adam.
Thank you. See you again.